Welcome back, options traders, and happy Wednesday to everyone. Well, just the other day, I got a really good question from one of the traders in our group asking about risk reward ratios. Now, I'm not saying this was her reason for the question, but I decided to do this video because I can't help but think that every time somebody asks a question about risk reward ratios, that somebody, whether it's the person asking the question or people reading it, are going to misinterpret it. Because everybody that hears about risk reward ratios always assumes that the reason you're doing this, trying to find out how to calculate these risk reward ratios, is because you want to find things that where you spend a very little bit of money, in other words, risking very little, but potentially have very big rewards. And they assume that that somehow makes that trade better. However, what I want to show in this video is that that's really incomplete to just talk about risk reward. Instead, you need to think about the risk reward price connection. So why do we need to include price in this chain? Well, let's go find out. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps so much to promote the channel. So let's start off with a 100-105 vertical spread. Remember, we get our bends at 100 and at 105. So here I've drawn the risk graph to where you can pay 250 to make 250. So if it's a debit spread, maybe you're buying the 100 call and selling the 105 call, you have to pay 250. And remember, if it's a debit spread, it's an asset spread. It can grow to the difference in strikes, which in this case is $5. So if you pay 250 and it grows to a value of 5, the net that you put into your pocket is 250. So here we have a situation where the risk and reward are balanced. Now, if you want to get hung up on the credit spread because everybody thinks that credit spreads are better, that's fine. You could look at these as put options. You could buy the 100 put and sell the 105 put and turn it into a credit spread, collect a 250 credit, but now it's a liability equal to the difference in strikes. So if you can collect a 250 credit, but now are exposed to a $5 liability, the most you could lose is 250, and you're right back into the identical risk graph. So don't worry so much about debits and credits or calls and puts. It's more about the direction that we're looking for, in this case bullish, and what price are we paying. That's really an important theme that I think everybody misses. So whenever we have a risk graph, a vertical spread like this, where the risk and the reward are balanced, it's because the stock is currently dead center between the strikes. Now, if you put this into a pricing model, you're going to find that they're not exactly balanced. It might be 252 to make 248. There's going to be some type of a little bit of a skew, and that's usually because you either have an interest rate in there or, if nothing else, because of volatility that's allowing these prices to compound. But the idea, the concept is exactly the same. Now, another side note, I'm not a big fan of using the term risk to identify or label the price that you're paying. Because when you do that, that's what sets up the misperception. Because if you had to pay 3 to make 2, people start thinking that it's bad. I have to risk more to make less. And again, I think that's why a lot of people ask these questions about risk-reward ratios. So in this case, different brokers might even list risk-reward ratios. So how would they do this? Well, here they're going to say maybe pay 250 to make 250. That's how most traders would talk about it. But we could also reduce it down dollar for dollar, and we could say its risk-reward ratio is 1 to 1, that you are risking $1 to make $1, just a mirror image. But now let's say that we look at a risk graph, a vertical spread, like this. It's still the 100-105 vertical, but now maybe we have to pay $1 to make 4. Or the way that most options traders would say it, I have to risk 1 to make 4. And when you word it that way, it sounds better because they say, well, I'm only risking a little bit, but I might make a whole bunch, as if it gives them an edge. But the only reason that this pricing relationship exists is because the stock is down here, maybe around 95. It's super high risk, or in other words, a low probability of this thing ever even paying off. In this case, the stocks got to move from 95 to the long 100 strike just to get you at the money. You're still at maximum loss. Then you've got to move another 5 points to 105 if you want to get to that maximum gain. So, yes, it's a very long, fast, aggressive move that the stock must make, which is unlikely. So, traders push the price down and they say, well, in order to make this fair, in order to get somebody to take the other side of the bet, we've got to push this price down. And so the market will just figure that out on its own. And that's another key point of this video. As soon as you put a price to this, in any kind of an active market, which the stock market is, you have to say it's probably factored in there. You shouldn't look at this just because it's a 1 to 4 risk reward ratio and immediately assume that it somehow is better. It's just riskier. The market knows that. All the buyers and sellers know that, and it's therefore been priced in. So in this example, your broker's platform, again, they will show it in different ways. They might show it as pay 1 to make 4, or risking 1 to make 4. Again, it sounds very good when you word it that way. They might also just put it in a risk reward ratio and say it's 1 to 4. That's the same thing. But they could also put it in a $1 scale and say that we're going to put the rewards at $1, and therefore the risk reward ratio is 0.25 to 1. In other words, for every 25 cents that you're risking or spending, you could make $1. Now again, this is why people like these risk reward ratios, because this looks phenomenal. I'm only risking a quarter, but I might make $1, as if that somehow gives you an edge. But back up for a moment and ask yourself, why would somebody offer you this spread at this price? Why would they do that? Why does the state lottery allow you to pay $1 but maybe make 20 million or 100 million? You could say, oh, it's a phenomenal risk-reward ratio. Well, how does that appear? It appears because it is super high risk. That's the way that you want to see this. Now, if you're after high risk, that's fine. I'm not going to say it's bad, but don't look at this and say it's good or that it's less risky because you've got a great risk-reward ratio. Now, let's look at this from the other side, maybe something like this. But now let's put the prices to where you have to pay 4 to make 1. See, now it sounds really bad if you say that price is risk. It's a reflection of risk, but that's why you shouldn't really say it's the risk. Because the reason for this relationship, paying 4 to make 1 in this vertical spread, is because the stock is up here. It's already into the maximum gain zone. Remember, on the previous one, the stock was at 95. It had to move from 95 to 100 just to get your long option at the money. Then it had to move to 105 to get you into this position. We're starting here. That's a huge benefit, and you always have to pay for benefits. So the market realizes it's an advantage, and traders start aggressively pushing up the price until they can't quite differentiate it. Can't tell if it's good or bad. It just seems to be about fair. So again, even though a lot of traders would say, oh, this is a bad spread because it's a horrible risk-reward ratio, that is simply not true. You're only looking at the risk or the price and the reward. You're not accounting for the probability of winning. So all three of these spreads that we've seen theoretically are identical in terms of risk and reward. Why? Because they've been priced according to risk. But back to this vertical spread here, pay 4 to make 1. Your broker's platform might show it as pay 4 to make 1, or a risk-reward ratio of 4 to 1. Or if they want to put it on a $1 scale, they might show the risk-reward ratio as 1 to 0.25. For every dollar that you are risking, you can make 25 cents. So again, it sounds horrible. But the reason it sounds horrible is that you're assuming that the probabilities are equal. And that's why some traders scratch their heads and go, why would I risk $1 to make only 25 cents? Well, the answer is very clear and a very good one, because the odds are in your favor. You've got a much better chance of making the 25-cent reward. So the thing to remember is that we always have to fall back on this idea of fair value. Don't ever forget this. Don't get stuck on risk reward ratios or I've got a high probability of winning. They are all tied together. So if you have to spend $4 to make one, why is that happening? Well, it's because of the probabilities. And that's again what most traders don't account for. So in this example, you have roughly a 20% chance that you're going to lose 4. We multiply those out, we get minus 0.80, and you have an 80% chance that you're going to win the $1 reward. We multiply these out, we get plus 0.80. And notice that when we do that and when we combine these numbers, we get 0. So if we get a net 0, it means it's a fairly valued bet. It's not good, it's not great, it's just okay. It's fair to both the buyer and the seller. But take a look at the probabilities. Do you see how you have 4 times the number of ways to win? Again, that's an advantage. The market recognizes it. Sellers recognize it. And therefore, you've got to take a hit on this side to the tune of 4 to 1. You're going to have to pay 4 times the amount of the reward. And that's what's making it balance. So if it's fairly valued, whether we have pay 250 to make 250 or pay 1 to make 4, pay 4 to make 1, it doesn't matter because it's been accounted for by the price. So once again, if you get stuck on this whole idea of risk-reward ratios in an attempt to try to identify better strategies, all you're going to do is be diving into riskier strategies. So let's bring up an Excel spreadsheet and see how this actually works. All right, so here's an Excel spreadsheet, and I've designed this to where we can customize it. And I've got in this column where we can draw a random number from 1 to 2, and we are going to win if we draw the number 1. So we have a 50% chance of winning, or 1 to 1 odds. So this would be pay 250 to make 250, or bet $1 to make $1. So I can now change the value of the bet. Let's make it at fair value right now at $1. And take a look at this graph over here. Now this is 10,000 tries, and you can see it's just going sideways. The green lines are plus and minus 1 standard deviation. The red lines are plus and minus 2. Now if I hit F9 in here, you'll see that we still go sideways. So here we're still going sideways. This time we dipped a little bit below 1 standard deviation. So in this instance right here, notice at 0, that's where we're just breaking even, that you stayed above breaking even. In other words, you were in profit the vast majority of the time. And that catches people by surprise. They usually think that you're just going to oscillate, gain, loss, kind of back and forth. But that's not true. There's actually long periods before you switch from gains to losses. Now, why is that important? Well, you can see how this trader would think after all of these trades, oh, I'm on to something. I'm looking for really good risk-reward ratios where I use my RSI and my Fibonacci's and I tend to win. And it's just pure luck. That's just the nature of randomness. Because here's a case, here's 0 again, where you stayed underwater most of the time. And now people start blaming the market makers and saying, oh, I used to be doing so good, but now I'm just off, or I'm out of sync, or something's wrong. It's not. It's not understanding this is the way that randomness works. So just because you might say, oh, I only look for good risk-reward ratios and I had a good year, that doesn't mean that that's necessarily why you're doing well. The market knows that. And so you have to say, if the market knows everything that you know, chances are the price that you're paying is fair. Now watch what happens if we make this, let's say, $1.30. So now you're paying more than fair value. Look at that. See, now you've got no shot of ever coming out alive. There's another sequence. There's another one. Look at that black line. Hardly moves. And that's just paying a little bit above fair value. Now, what if you could get it below fair value? Maybe you could pay 90 cents. See, now it's very different. There's another sequence. There's another, look at that. Just always staying above 0. And that's because you're paying below fair value, not because it's a great risk-reward ratio or because it's a bad risk-reward ratio. it's because of price relative to probabilities. And when you have price relative to probabilities, the risk-reward ratios fall into place. That's why it's wrong to look at the risk-reward ratios and think that they somehow give you added information. They just simply don't. So let's go to another one that we saw. Let's put in 10 numbers into a hat, and we win if we draw the numbers 1 through 8. Now we have an 80% chance to win. You can see right there the odds are 4 to 1. So we know that because we've got a high probability of winning, we should have to pay 4 to make 1. So if we pay 4, now look at this black line, just going sideways. The market recognizes that that's the fair value. If it's trading below that, buyers are going to push it higher. If it's trading below that, sellers are going to push it lower. So let's try another sequence here. Basically sideways, still within our 2 standard deviation bands. And you can see just going sideways, but lots of variation in there. Again, that catches people by surprise. You can certainly mistake it for being a genius at trading, and it's just simply dumb luck. But you can see overall it's going sideways. Now watch what happens if we pay maybe 420. See, now we're going to be on the losing side more often than not. Look at that black line. There's definitely a downward trend towards it, paying above fair value. What if we push it a little higher? Let's make it 440. See, now we can definitely see it. See, that black line is now consistently on the low side. And when that happens, what's going to occur? Well, sellers are now going to realize it's a great thing to sell. They will sell it and push the price below 440 or back towards 4. What if they push it too far and it's now trading for 350? See, now you're always on the high side. Now the buyers win. So the buyers are going to be jumping all over this. So the buyers are going to be pushing the price up towards 4. So it just goes back and forth. So traders have just learned for these types of trades in these situations, you should pay 4 to make 1. And that's why they will settle there. So if you come along and say, this is a horrible trade because you have to pay 4 to make 1 or risk 4 to make 1, that is missing the point. You have a much higher probability. All right, now just to be clear, let's go back and let's maybe do 10 numbers, but we win only from 1 through 2. Now it's a 25 cents to 1. That's what we saw before. So we should have to pay 25 cents to make $1. And there we go. Just going sideways. It's not a good bet, not bad. It's just fair. But watch this. This can be an easy trap to fall into. Let's say it's priced at 50 cents. See, it's horrible. You don't want any part of this because the price is too high. See, that's why you can't just get focused on the risk-reward ratio. You have to say, do I have information that nobody else in the market has that warrants this price and makes me think that that price is too low? And if you're using your RSI and Fibonacci's, not that I'm picking on those two, but whatever indicators or whatever public news that you're reading, everybody else knows that too. Don't think that it's giving you an edge just because you found a good risk-reward ratio. Instead, you have to say, what is the fair price for that bet? And now you're on your way to thinking like a trader. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a brand new candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.